Well, a very warm welcome to everyone joining us today on the webinar. A very special welcome, of course, to all our Australian Technical Analysts Association members, and also a very warm welcome to all of you who are not yet members of the ATAA. My name's Alan Clement. I am a National Director with the Australian Technical Analysts Association, and it's my very great pleasure to bring to you the first in this new initiative, which we're calling our National Speaker Series, where we aim to bring you the best names in the trading, market analysis, and strategy development worlds. And our guest today is none other than Brent Penfold. If you're not yet a member of the ATAA, I do hope that you'll consider joining us. You would have seen on the rotating slides that we do have a special offer running at the moment where you can join us for just $1 Australian for the first 3 months of membership. I will post a link to that in the chat. So when you get a chance, I encourage you to take a look at that offer. A couple of housekeeping points before we get going today. Today's webinar will run for around about 1.5 to 2 hours in duration. There's a Q&A button down at the bottom of the Zoom window there. Please use that to submit any questions you have for Brent, and Brent will answer them at the end, moderated by one of the hosts here. We are recording today's meeting, and it will be made available to everyone who is registered, whether you're watching live now or whether you have to dash off. That recording will be made available after the presentation today. And now, without further ado, on to today's presentation. So Brent, would you please share your screen? Brent Penfold is a 40-year veteran futures trader who began his trading career as an institutional trader with the Bank of America 40 years ago. Brent is well known around the trading world and the trading community. He's known especially for his disciplined, systematic approach to trading across a diverse portfolio of futures markets. In today's talk, you will hear from Brent on how to break free from that trap of endless analysis, his proven process for creating a strategy that works in the real world, and some practical steps you can use to transition from theory to profitability. So please join me in giving a very warm virtual welcome to Mr. Brent Penfold. Brent, the floor is yours.
Great. Thank you, Alan, and hello, everyone. And thank you for attending this online presentation. Analysis is good, but I can assure you making money is better. And I'll be teaching you how to build a robust mechanical strategy for profit. Now, before we commence, please let me give you a little bit of background information on myself. As Alan introduced me, and for those who do not know me, my name is Brent Penfold. And I hope I don't look it, but I'm just trying to, remove the wrinkles. I've been involved with the market since 1983 when I joined Bank America as a junior trainee dealer. As a trader today, I specialize in trading global index, currency, and commodity futures. I've written a number of books. I help educate people, and hence why I'm happily involved with you guys today. And I'm an advisor. For my contact details, you can see those below. Under Australia's disclosure rules, I'm required to let you know that my presentation today is educational only. It does not contain any investment advice. It does not contain personal advice. It only contains general advice. In addition, if you don't know already, there is risk of loss to the power of infinity in trading. In addition, if you like what I share with you during my presentation, and I hope you do, you need to determine, either with or without the assistance of a person licensed to give personal information or advice, whether my ideas are suitable for you, given your own particular needs, financial situation, and investment objectives. I have to be very clear about this. I'd like to give a big thank you to the Australian Technical Analysts Association for generously inviting me to talk to you today and to share with you what I do. So a big thank you to the Australian Technical Analysts Association. In addition, I'd like to thank my data supplier, Norgate Investor Services, for their outstanding premium datas, end-of-day futures and Forex data. But more importantly, I want to thank everybody who is online today, and for those who may not be able to be with us today, but will be listening to this recording later. A big thank you for your giving up your time to share it with me and for supporting this presentation. Now, my big preference is for everyone just to sit back and listen. And I really would prefer if you don't try to write down everything you see on your screen. I say this for two reasons. One, I have so much to share with you, an enormous, probably too much to share with you. And so I will be going fast and you won't be able to keep up with me. So that is going to frustrate you. And secondly, as Alan said, this presentation is being recorded. So you will have plenty of opportunities tonight or tomorrow or the following week, excuse me, to watch this presentation again, to pause it, to rewind, fast forward, do whatever you like. So you'll have plenty of time to come back here and write down anything specific that you would like to. So just sit back and just, from a holistic point of view, try and come along with the journey that I want to take you on. Please also understand that just because I say something doesn't necessarily make it true. All I'm sharing is one person's opinion, and that's mine. And so if you like what I share with you, it's up to you to verify my ideas to make sure that they represent truth to you, okay? So don't take my word for anything I say. Please independently verify everything I share with you if you wish to implement it. Now, as we know, there are many roads that lead to Rome. And similarly for trading, there are many ways to trade. And also, there are many ways to develop a strategy. I'm just going to be showing you one way, which is mine. And I'm not suggesting my way is the best way. I'm just, through all my ups and downs, I've managed to work out a path that suits me. And that's all I'm sharing with you today. Okay, I'm not saying it's the best. I'm just saying it's my way. With that preamble out of the way, let's move on. I am here to help. And I'm here for one reason, and that is to help you transition from the wealth of knowledge that you have with your analysis to making money, to help you learn how to create robust mechanical strategies for profit. So let's have a look at what I want to cover today. Now, I love analysis as much as the next person, but I prefer and love making money far more. And that's what I want to try and steer you guys towards today is, yes, you've got a wealth of knowledge, but it's time to narrow that focus down to what really counts, which is building your trading account. So I want to start off today. I want to give you a bit of background on myself, how I started. I want to share with you how I trade, and then I want to move on to my development toolkit, where I'll be spending the majority of this presentation. And my toolkit is all about how to develop a robust mechanical trading strategy. So I hope that's all good. So let's get started. We'll commence with my background. Even though I'm a mechanical trader today, I did not start out as a mechanical trader. For the first 12 years of my trading career, I was involved with Elliott Wave. And then in 1995, I learnt geometry from Bryce Gilmore, where I overlaid geometry over geometry of time and price over my Elliott Wave analysis. Now, although combining Elliott Wave with geometry was certainly an improvement for me, it still wasn't enough. And in my hands, and I'm just talking about my own personal experience, in my hands, I found Elliott wave combined with geometry, it was still too subjective and too unreliable. I still didn't have an edge after 15 years. And during that time, I blew up 2 accounts and I almost blew up a 3rd account. So the question is, what finally did work for me? And what worked for me was becoming a mechanical pattern trader in 1998, which is what I am still today. So let me give you a little bit of insight into how I trade. We'll commence with my mechanical pattern trading. The tide turned to me. Oops, I've just, what have I done? I've just tried to enlarge my window and get my, there we go. Oh, that's better. Sorry for the interruption. I've got my screen back. The tide turned for me when I discovered the simple daily bar patterns that had a statistical edge. It's all I did. For example, one of my bar patterns is a bar pattern I call bouncing ball. And all it is 5 consecutive bars where the market has closed lower than it's open. So it's closed down, it's closed down, it's closed down, 4, 5. On the 6th bar, I'd buy market on open, and then I'll just exit on the following bar, market on open. So for me, I found that simple bars were objective, and it allowed me to gather evidence about whether that pattern worked or not. So I found it very simple. That's essentially all what I do. My patterns have changed, my patterns, but they are patterns. They're just price. That's what I trade. I just trade price. So I became a mechanical pattern trader. In addition, I learnt the truth about trading. I learnt profitable trading was not about palm trees and laptops. And if you still have some beliefs that is what trading is all about, I'm sorry to disappoint you, but certainly from my experience, trading is not palm trees and laptops. In my opinion, trading is the hardest way to make the easiest money. Now, I learned profitable trading wasn't, laptops and palm trees. I also learned that profitable trading was not about picking winners. It wasn't about forecasting tops and bottoms. It wasn't about finding a magic indicator. It definitely wasn't about finding the perfect entry technique. Certainly it wasn't about being the smartest trader, because I'm certainly not the smartest person at all. Being profitable is not about being right about the market, and it definitely was not about knowing trading secrets. No, what I learned was this. I learned profitable trading is all about 2 key factors. Number 1, the math. You need to trade with a 0% risk of ruin. And secondly, you have to be the best loser. They were the key understandings that I discovered, and is the sole reason why I'm here today and I continue to trade, because I embrace these 2 concepts. So I discovered the universal truth about profitable trading was not about, picking winners and making good forecasts. It was simply the math and being the best loser. The math is simply combining a good percentage money management strategy with a good positive expectancy methodology. When you combine those 2, they will give you a mathematical probability of whether or not you're going to ruin yourself. You have to be trading with a 0% risk of ruin. That is the math of trading. And in addition, you have to become the best loser. You need to welcome your losses. When you see your losses arriving on the horizon, you have to stop running away and hiding under your couch. No, you've got to do the complete opposite. When you see losses on the horizon, you have to stand up and charge towards those losses, and you have to embrace them and smother them in kisses, because they're going to become very intimate to you if you wish to trade like a full-time trader. Because, well, certainly my experience is the most constant companion I have, or the most regular thing that I do as a trader, is I lose. But geez, I'm a good loser. I am a gold medalist loser. So you need to learn to welcome your losses. You have to learn to endure the pain of losing. It's part of trading. You have to ignore hope, fear, and greed, and you have to stick to your plan. You need to develop a proper mindset. You have to develop a good trading psychology. And remember, the only real secret to successful trading is that the best loser is a long term winner. And these universal truths are based upon the universal principles of successful trading. Now, I recently experienced two back to back drawdowns in 2021 and 2023. And this universal truth that I discovered years ago is the sole reason why I survived. This universal truth, it's my foundation, and it's a reason behind, as I said, my survival. And if I survive, then by definition, I am successful. So that's what I learned. That profitable trading is only based on two key factors. And I hope for those of you who aren't familiar with these key concepts, I hope you investigate them more. In addition, over the years, I have come to enjoy the benefits of mechanical trading. And these benefits include what I do once people understand what I do, it's simple. It's objective. Being mechanical means there's no need for interpretation. There's no need for analysis, no judgment, none. When you're a mechanical trader, everything is measurable. And if something is measurable, you can verify it. You can calculate what your expectancy is. You can calculate your mathematical probability of ruin. It's easy, it's mandatory, it's essential, and mechanical trading gives it to you. And it's evidence-based trading. I don't trade based on opinion. I don't trade based on faith. I don't trade based on a picture perfect chart example. No, I trade with a statistical edge, which just comes from gathering evidence in a huge pool of trades, like a huge sample size. Will those particular patterns continue to have an upward sloping, positive expectancy into the future? Who knows? But the probability suggests they may. But I don't trade just one single pattern. I trade a multiple portfolio of patterns. And I do it all because of the evidence. Mechanical pattern trading is also confidence building. It dead set is. It's like anything. If you get success, then it just builds your confidence, which is wonderful. And you get consistency. And it gives you, and I've enjoyed, emotional stability. Like in this past week, around the globe, it's been one of the most volatile times in global equity, interest rate, and currency markets. Unbelievable. Now, during that period, I've continued to, download my data, run my models, update my positions, enter new orders, move stops, get stopped out, take profits. Nothing stopped for me. I just did my work, and then I got my popcorn out, and I was, like probably everyone, I was glued to my screen. It was just so entertaining seeing what was happening around the world. And I could do that because I'm a mechanical trader. So there's no emotions in what I do. It's just my models are trading. Certainly I have to care for my models, but from day to day to day, it's just the models that trade. I mean, I'm the young bloke who, puts everything in, but it's my models that are trading. And time management, another benefit I've enjoyed over the last 27 years being a mechanical trader is the time management. Like right now, it's about 20 past 12, and I'm on schedule, which is good. I'm just looking at my running sheet. Now I have finished everything I have to do for my trading for Monday. Like I'm finished. I'm finished. My data becomes available to me in Sydney at 10:30 a.m. in Sydney, and so at 10:30 this morning, I downloaded my data. I ran my models. I adjusted my stops and exit instructions for open positions. I've placed orders in for new orders, and I actually have traders with me, still with me today. I do an annual workshop each year at the end of the year. So that was at the end of 24, and then I always do 90 days of live trading, and I still have my traders with me because they watch me trade the strategies I teach, in real markets in real time, and so I have to do work for them. So I've got to do work to prepare emails to send out the setups from the models, and send out a copy of a chart example and a copy of my orders. So I'm doing actually more than what I'd normally do, and I was finished by 20 past 11 this morning. Like I finished. I don't, and I got my orders into my Interactive Brokers trading platform. Essentially, I can relax now until Tuesday morning because I trade on a set and forget basis. I trade off daily bars, and if I've got a new order, order will go in to buy or sell, whatever it is, and it'll always have a stop attached. If it gets triggered, a stop will work. And I trade on like a 24-hour cycle. And so I put all my stuff in for Monday, and I was finished by 20 past 11. Now it's 20 past 12. So I've been finished for an hour. That's a huge benefit, time management. And in addition, it's profitable. So that's very good. Also, I know, and I hope I can encourage you to believe too, that diversification works. I mechanically trade a diversified portfolio of markets, strategies, and timeframes. I trade 3 of the most liquid futures markets across 8 diverse sectors, and I add 6 additional global indices because my background is index trading. So I trade a total of 30 markets, and I trade a portfolio of strategies containing both trend following and counter trend or mean reversion, and I trade a portfolio of timeframes. And so, I'm very diversified. And as I was saying before, with time management, I do trade 30 markets, and I trade over 20 models, split between trend trading and counter trend trading over multiple timeframes. And I'm finished. I've done everything. Everything's in my Interactive Brokers Trader workstation platform. In addition, I come to think of myself now as more of a risk manager rather than a trader. My sole objective, I feel, is to avoid risk of ruin. And so to help me avoid risk of ruin, I try and I do, and I am successful at eliminating any reliance on any single market, strategy, or time frame. Because in my experience, no single strategy on any single market, on any single time frame, is going to make money every year. And why would you want to expose yourself to a point of failure, either the market blowing up, the strategy equity curve diving? Well, nothing can really happen with time. Time's time. But why have yourself exposed to those single points of failure? So I see myself as a risk manager, and I achieve that by diversifying what I do. So essentially, that's how I trade. I just trade primarily price. I do trade with a few indicators, but I'm primarily a price pattern trader. In my mind, I understand what the truth is about trading. I've enjoyed the great benefits of mechanical trading, and believe me, diversification works. And if it helps you, because I know it certainly helps me, I think of myself more as a risk manager rather than a trader. So let's now move on to my development toolkit. And I think I deserve a huge round of applause because looking at my run sheet, it says I should be at this point at 23 past 12. Looks like it's probably a bit past that. So thumbs up, I'm on schedule. I want to share with you how I develop robust mechanical trading strategies. And as you'll see, it's quite an involved process. But a lot of these steps, you can have them set up, and you have them set up for life, basically, and then you just have to, repeat the later steps. Now, it all begins with portfolio construction, and I want everyone to listen up. Even if you only have a very small account and you feel you can only trade 1 or 2 markets, what I'll share with you is what I do and what I would expect anyone to do if they want to be serious about trading. Now, every trader's twin evils when developing strategies are excessive curve fitting and data mining. Now, curve fitting will always be present when we're developing strategies. It has to be. You'll see a pattern in the market and you'll think, oh, is that a repetitive pattern? And so you'll develop a model to capture that pattern, even though it's a very simple pattern, right? But the fact that you are curve fitting, a little pattern to your data means you are curve fitting. So every strategy that has been developed is curve fitted. But the trick is to avoid excessive curve fitting. So curve fitting will always be present, while data mining or cherry picking only the best markets, that can be avoided by objectively selecting a well-diversified portfolio of markets. So even if you can only afford to trade one market, right, you should ensure that any strategy that you develop is robust enough to trade any markets and all markets, okay, into the future. Yes, you may only be able to trade, say, two markets, but you'll be doing so with the knowledge that your strategy is robust enough to trade any market. And as your account balance grows and you can afford to trade more markets, you'll be doing it with confidence. So you may think it's an overkill today to create a big portfolio because you can't afford to trade more than one or two markets, but you'll be setting yourself up for success in the future because one, you're going to be developing a strategy that you know is robust enough to trade on all markets. And then when your account balance does grow, it's going to be easy for you to achieve scalability. So you need to build and select a diversified portfolio like mine to develop strategies. I have a portfolio I call P24, which is 24 markets, and I call it my universal portfolio. I'm a futures trader. I trade the 8 sectors: energy, indices, grains, livestock, softs, metals, interest rates, and currencies. And then what I do to make sure that these contracts or these markets are objectively selected, not subjectively, but objectively, is I just trade, the 3 most liquid contracts. These are the 3 most liquid contracts within their sectors. That's the reason, that's how they found their way into my universal portfolio that I trade. If you're a share trader, you need to do a similar thing. You need to get your sectors out of the share markets, your consumer discretionary, staples, energy, financials, metals, mining, minerals, real estate, utilities, industrials, healthcare, telecommunications, right? You've got to set it up properly. And you've got to pick the 3 most liquid shares within each sector, right? You cannot include the shares that you are the most familiar with. You cannot include your pet share. You've got to, if you want to be serious about trading, you've got to be serious about the process of trading. And this is a key thing. We know that there will always be curve fitting in how you develop your strategies. And the big warning there is just don't overdo it, right? The second big mishap for people when they're developing strategies is they data mine. They only use the best markets. They only trade the best historical markets for their strategies. And suddenly, their strategies start losing money and they wonder why. Well, the reason why is because they data mined it. They just picked the best markets. So you need to construct a large diversified portfolio so that any strategy that you develop is going to be profitable in any market. Secondly, you need data. I subscribe to Norgate. I use their premium data. The data actually starts for some of the contracts. The futures market started in 1979, but generally, it's 1980. I use the back-adjusted continuous futures contract, and I use the combined all sessions data. So I essentially trade like a 23-hour market 5 days a week. But being in Australia, sometimes it feels like it's 5.5 to 6 days a week because North America closed this morning at 7 a.m. and it will open up in Australia, in Sydney, on Sunday evening. Now, you will need data to properly investigate, develop, and validate strategies. Once again, you may think this is an overkill because only you can afford to trade one market or two markets. But, if you want to set yourself up for success, and I believe we're all going to live to 100, right? And if you're sensible and you trade small relative to your risk capital, believe me, if you can embrace risk of ruin, if you can embrace being the best loser, over time, your account balance will grow. And as your account balance grows, you'll be able to trade more markets, right? Trade more strategies. It's just self-fulfilling, right? Now, to set yourself up onto a good sustainable pathway, you've got to start today on the right foot, which is get yourself an objective and a diversified portfolio and get the data to support it. You have to invest. If you haven't already, you need to subscribe to a data service and do it today. For me, I use Norgate. They're excellent. I have never had a problem. I've never hit download and I've never had it stop or never had it turn off. I've never missed a day. So my experience, Norgate are good. Obviously, you can subscribe to whoever you want to, but Norgate, I get the futures and the Forex. I don't trade shares. I invest in shares, but I don't trade shares. But you can also get shares with a global coverage too from Norgate. But the point is, you need data. In addition, traders need to develop their coding and verification skills. Traders of mine who have told me and who prefer third-party charting packages, they use Amy Broker, Channelize, Multi-Charts, Real Test, Trade Navigator, Trade Guider, Trade Station, and Trade Block. Now, I'm not sure what else is out there. I'm sure there's more out there. I personally don't use a third-party package, but I'm sure if you do a Google search or you ask other members of the ATAA, you'll find there's even more choice to choose from. Those traders of mine who are professional programmers and then they prefer to program directly from languages, I know they use Visual Basic, Python, Java, and Ruby. The point is, you will need to get software. I'm sorry. If you wish to trade like I trade, and if you like to develop strategies like I do, then you need to get software. It's essential to properly investigate, develop, and validate strategies. If you haven't already, start exploring your options. Start it now. So these are key tools. You've got to get your portfolio, an independent, diversified, objective portfolio, no cherry picking. You have to get data to support that portfolio, and you need software to help you, to give you the skills to investigate, to develop, to scrutinize, to play with. You need software for that. Next, you need to learn how to review your strategy. Now, unfortunately, there is no single super metric that can rank strategies. None. Believe me, I have searched high and low for that one metric to rule them all, but without success. And what I've learned over the years is I've got, as part of my strategy review, I basically look at three key components, which is I will review the attributes of a strategy that I'm developing. I then want to see a performance review, and then I want to make sure that there's some equity curve stability in the model. I wish there was a single metric that could do all of this, but I've not found one. So there's quite a bit here. Excuse me. Okay. Commence with attributes. I want any strategy of mine to have as many attributes that winning strategies have, which is, are they measurable? Is it robust? So these are attributes of winning strategies. And their first attribute, all winning strategies are measurable. You can build an historical equity curve or you can do a back test to build an equity curve. And from that, you can calculate your expectancy and then your risk of ruin. So that's the easy part. The second part is that by definition, winning strategies are robust. They work. Now, there's two ways you can identify robustness. One, simple evidence. Is there out of sample performance since they were first publicized? If there's no evidence of robustness, you can look for indication robustness. And two key indications of robustness is number one, versatility. If your strategy is profitable, even though you can only trade one or two markets, but if your strategy is profitable over a large, diverse portfolio, that's a key metric or a key tell of robustness. Another key tell of robustness is a stable equity curve, and that's usually a function of good design principles. So we'll be looking at this later in detail, but we need to have a review of these key attributes. Does a strategy that we develop have those? Secondly, if I'm happy with those, with the attributes review, I'll then move into a performance review. And what you'll see here is my hierarchy of needs. This is what I need for myself. First of all, I want to survive. So the first thing I look at is risk of ruin. Dead set is the first thing. Is it 0% or not? If it's not 0%, forget it. Just walk away from the strategy. Secondly, if I know I'm going to survive, I want to know how much pain is in front of me. I want to know what's been the absolute worst historical drawdown. And that's a key metric, dead set. It doesn't matter how appealing or how clever a strategy looks and how otherworldly it looks and like it's just shiny, shiny, shiny. If it's got an enormous worst historical drawdown, well, I'm not money bags, I'm not a hedge fund. So I'll just move on. Thirdly, if I survive and I can endure the pain, I want to know what my risk reward is. One of those risk rewards is what's my risk adjusted performance? What's my ULSA performance index? How many units of return can I expect for every unit of historical drawdown? Right? I want to know. I want to look at the risk adjusted performance, and if I'm happy with that, I then go on to see how efficient is the strategy at making money. And that's usually a function of its stops. Big stops, you'll find most strategies are very poor at making money. Strategies with small stops are very good at making money. And then finally, for my hierarchy of needs, I want to know how difficult a strategy is to trade. Okay, and that's the R squared. The R squared is a line of it's a regression line, and a perfect equity curve would have an R square measurement of 1, right? 1. It's a perfect fit. I generally like strategies to have an R square above 90%. Below 90%, you'll find the equity curve is quite bumpy and quite rough, which makes it difficult to trade. So this is my performance review, and we start off with survival, risk of ruin. Now, risk of ruin, in my opinion, is the most important concept in trading. And as I mentioned before, risk of ruin is a statistical concept. It tells a trader their probability of being ruined. That is, the likelihood that they'll incur such a large accumulative loss that they'll stop trading. That's the first thing I look at. It has to be 0. Then with my hierarchy of needs, I need to know what pain is ahead of me. What's been the worst historical drawdown? Then I need to know what my risk reward is and what my risk adjusted return is, my ULSA performance index. How many units of return can I expect to earn for every unit of average historical drawdown? If I'm happy with the risk reward, I then move on to the efficiency, and I want to know how efficient it is at making money. What is the compounded annual growth rate? And then how difficult will the strategy be to trade? Like how bumpy or how smooth is the historical equity curve? I want to know what the R squared measurement is. So this is my performance review. And then finally, if my strategy gets over those two hurdles, I need to do an equity curve stability review. And it's all about how many variables are in a strategy and how many adjustments are you going to allow for each of those variables. Because for every variable and every adjustment, you'll get an alternative equity curve. For example, if you've got 2 variables and you allow 4 adjustments, then your universe of alternative equity curves contains, I think, 16 equity curves, 16 different equity curves with 16 different calculations for expectancy, risk of ruin, and the R square. And That will answer the question, do any sets of variable values have a risk of ruin over 0%? Okay, this is the equity curve stability review, right? We want to know how stable our equity curve is, because even though we may agree on a set of variable values, I can guarantee you that over time you will adjust them. And so to get ahead of that, you should do this equity curve stability review now to find out how many potential variations that you'll get with adjusting your variables, and what are the resultant calculations, the impact to expectancy, and risk of ruin, and the R square. And with risk of ruin, you want to look for any risk of ruins above 0%. And if they're above 0%, don't trade the strategy, because that's what we want to know. Is the equity curve stable enough to trade? So that's the equity curve stability review. We will be going through an example of all of this. I know it's quite a lot, but I just thought I'd give you a heads up straight away. Next, what's really important is that every trader who wishes to develop a benchmark, okay, they will need to select a strategy to benchmark their efforts against. And they need to select a strategy benchmark because this will prevent traders from falling into what I call the relevancy trap. The need to be relevant by trading their own strategies. So unfortunately, most development efforts fall short, but despite the shortfall, you'll find that traders will still trade their own strategies because because people want to matter. They don't want to trade other people's things. They want to trade what they build. So you need to avoid this. To avoid this relevancy trap, traders need to select a strategy benchmark to beat. So that if they can't beat it, and if they still wish to trade, then they should trade the strategy benchmark. Because logically, if you've got a strategy benchmark and it's good, and that's the hurdle that you want to beat, if you can't beat the hurdle, if you can't get over the hurdle, then wouldn't it? You just be stupid to trade the strategy which failed to achieve those heights. It'd be stupid, but most people do. So by having a benchmark in place that you're trying to beat, it just introduces a bit of discipline into what you're doing, okay? And if you still wish to trade and you can't outperform the benchmark, then trade the benchmark. For me, I use the Turtle trading system as my benchmark. For me, it has the best combination of robustness and good performance metrics. For robustness, it has 40 years of positive out-of-sample performance. It's unbelievable. There's 42 years of positive. See, it works, right? That's so simple. It only has two variables. Fantastic performance metrics, and as a strong risk reward of 11 to 1. So for every unit, if it's worst historical drawdown, it's given you 11 units of profit. It has an excellent risk-adjusted ALSA performance index of 1.9. That's actually outstanding. And it has a healthy compound annual growth rate of 23%. So for me personally, that's what I have to beat every time when I'm developing a strategy. And now we have to look at how I actually develop a strategy. So this is a long-winded way. It might appear to everybody it's a bit of a curvy path, but I had to take you along this long driveway before we got to my development, because without understanding the importance of having a diversified portfolio to test on, without understanding that you need data, you need software, and without understanding the steps within the review, and without having the discipline of measuring your efforts against the benchmark, then learning how I develop ideas wouldn't be as effective. And I have a very simple 3-step process. All I do is I look for old ideas. Once I find an old idea, I'll just code it, I'll review it, and I'll adjust it. And then I simply rinse and repeat. And I do that while hopefully avoiding excessive curve fitting. We commence with finding an old methodology. Now, note, I'll be focusing on developing a trend following methodology. Now, the question is, why is Brent so interested in an old idea? And that's a very good question, and I'm glad you asked it. The reason why I love old ideas, it gives you and I, and particularly me, because I'm more interested in what I'm doing, but I'm sharing with you what I do. I like old ideas because it gives me plenty of time. It gives me plenty of out of sample data for the idea to demonstrate to me it has an edge. Now, every objective, or an objective for every strategy is that whatever you develop will deliver a tradable robustness. Now, we know that when we develop a strategy, we do it on in-sample data, and then we hope once we go live with it on the out-of-sample data, we pray and we hope that the equity curve will continue to have an upward sloping shine to it. Now, the less time you have, right, the less robust a strategy is, right? The less time you have for out-of-sample, the less robust it is. The more time you have, i.e., the older a strategy is, like it's way back here decades ago, the more time that you have with an old idea, then the more robust it is. So old ideas gives me, and hopefully will give you, more time, which means more robustness, and more importantly, it will give you more confidence because you know the thing despite the drawdowns, and everything has a drawdown. Believe me, you'll never ever avoid drawdowns. But when you're in a deep, dark place, and you got your head between your knees, you will want to be able to look up and look back and see some of these key concepts you're trading and remind yourself, well, these ideas or key concepts, they're really old and they have generally kept performing. So the odds are they will keep performing into the future. So you just need to focus on keeping your risk at 0%, keep taking the hits, keep being the best loser, and you may surprise yourself and suddenly you pop out of your drawdown. And what gives you that confidence is knowing that you have developed an idea based off the back of a really old idea. And really, why should we have to reinvent the wheel when we don't have to? So, question is where to look. As I mentioned, I'll be focusing on developing a trend following methodology. Well, in the world of technical analysis, and we are at the home of technical analysis here in Australia, we are with the Australian Technical Analyst Association. That there is a wealth of choice, there's a wealth of opportunities to investigate for developing a trend trading strategy. Whether you wish to investigate astrology, Dow theory, use Fibonacci, geometry, market profile, seasonals, whether you wish to use cycles, Elliott wave, use indicators, patterns, WD GAN, there is a wealth of information out there. And basically, a lot of that stuff is old. I mean, you can go back to the very first, I suppose copy or existence evidence of technical analysis is there's candlesticks back in 1770. So that's over 250 years old. So there's plenty of scope or plenty of material out there for you and I to look at. Now, I have managed to find a lot of old trend trading methodologies, and I have them summarized here for you. Not all of them are really old. Now, these are actually just sorted alphabetically. This is Curtis Arnold's pattern probability strategy. He published in 1995. It's been out for 30 years. It's made historically on my P24 portfolio $450,000, average net profit of $174, and I've taken brokerage and slippage off all of these results. Now, the average true range band strategy, that's a strategy I've just published in my 2020 trend trading book. So it's only 5 years old. So there's really nothing there. You got the Bollinger Bands, Davis box, Donchian 4-week rule, Donchian's 5 and 20-day moving average crossover system. That's been known for over 65 years. You got Dow theory, got the Dreyfus 52-week rule. You got Alexander Elder's triple screen trading strategy. That's now 39 years old. So there's a lot of old strategies here. But let me just sort them by published date so we can see how old they are. So this is by the published date, right? Now, the oldest trend trading methodology is David Ricardo's rules. And he's the first one who was accredited for articulating trend trading, which is cut your losses short, let your profits run. That's been around for 225 years, and look at that, it's profitable. Hearn's 1% rule, he was a gambler. It may have worked back in 1870, but it doesn't work today, but it's an old strategy. There's Dow theory, Davis box, turtle trading. It's 42 years old now. So as you can see, there are a lot of old methodologies that you can choose from. What I'll do today is I'll have a look at Dow theory. I love Dow theory. So it's simple and it's really old. It's 125 years old. Its average profit's not very big, but it's something I can work with, right? So the idea is get an old idea, okay? And that's going to be basically your canvas. So let's see if we can develop a trend strategy based on Dow theory. Now, first, let's remind ourselves what Dow theory is, because I can imagine a lot of people joining us today know what Dow theory is, but some may not. Charles Dow is regarded really as a pioneer of technical analysis, and probably hence why I decided to pick him, because today we are with the Australian Technical Analysts Association, so I thought, why not? Why not give a nod to the father of trend analysis and one of the early pioneers of technical analysis, which is Charles Dow. And what I'm going to be focusing on is simply Charles Dow's peak and trough trend analysis, where higher peaks, higher highs trend up, lower trough, lower prices trend is down. Now, there's 7 main components to Dow theory, but the only component I want to focus on is Dow's mechanical interpretation of trends, which is basically a function of peaks and troughs. He defined, he believed an uptrend is defined by higher peaks and higher troughs, so higher prices trend up, and for downtrends, he defined them as being lower peaks and lower troughs, so lower prices trend down. So I want to simplify Dow theory just down to his mechanical interpretation of trends. So let's have a look at Dow theory's peak and trough trend analysis. Now, for everybody here with us this afternoon, you'll be happy to know that the only analysis I need to do is what I'm going to show you right now. So, yes, we do need some analysis, but we don't need a lot of analysis to make money. So, Dow theory, it starts with the swings. And by the way, swing charts is probably the main tool I use in my trading. And you can see it's not, it's old too. So, Dow theory, we're looking at the peaks and we're looking at the troughs, which is basically a swing chart. And in addition, you have to be aware that Dow theory is always in the market. It's either long or short. And it's what's called a stop and reversal strategy. So Dow theory is always in the market, either long or short. So for trends up, just look for higher lows, because a lower low will switch trends to down. For trend down, we just have to look for lower highs, because when you get a higher high, it switches the trend to up. So here we have higher prices, so trend up. There's a break up here, so trend up, higher highs. Now, as we go up, we just look at the lows. So we have a higher lows, trend up. Higher lows, trend ups. Whoops, we have lower lows, switch trend. Trend is down. Because the trend is down, we're looking for lower highs. Trend down, lower highs. Trend down, and whoops, we have a higher high. So the trend is up, the trend has switched to up. So now we're going up because we're long. And as we're long, we're looking for higher lows, trend is up, higher lows, trend is up. So it's as simple as that. Now, this is a daily bar chart. with a blue swing chart overlaid, and these black lines are just showing you where Dow theory does their stop and reverse. Okay, so the market's up, so there's a break up, trend is up, and Dow theory is long. It's in the market. So when we're long, we're looking for higher lows. Like a higher low, trend up, higher low, trend up, higher low, trend up, higher low, trend up. Whoops, lower low. Right? Is a breakdown. The lower low trend is now down. So Dow theory gets stopped out and it goes short. So Dow theory is now short. So remember, Dow theory is always in the market. Here we have lower highs, trend down, lower highs, trend down, and whoops, we have a high high. So the market breaks up. So that means trend is up. And so Dow theory is long. When you're long, you're looking for higher lows. So we've got a higher low. So trend is up, and whoops, lower low. Dow theory, because there's a breakdown and we have lower lows, the daily Dow trend switches from long to short, and the trend is down. When the market is going down, we just look for lower highs because that means the trend's down. Lower highs, whoops, higher high. We have a breakup, have a higher high, so the trend is up, and Dow theory has got stopped out here for probably, for a profit actually, went short here, profit here, and so Dow theory is now long. And when it's long, we're looking for higher lows, trend up, higher lows, trend up, higher lows, trend up, slightly higher lows, trend up, whoops, lower lows. We have a breakdown, lower low, the trend is down and it's short. If you can understand what I just went through with the peak and trough swing charts and showing you how Dow theory goes long and short. If you can understand that, then you are now an expert in Dow theory. So congratulations, because really it's simple as. So next we need to code, review, adjust, rinse and repeat. So we have an idea of what Dow theory is. And we want to do that without experiencing excessive curve fitting. Now, an important point, data. Do we split data or don't we split data? Do we look to develop our strategy on the first half of our data, and we'll call that in-sample data, to later test our strategy on the second half of data, which is the out-of-sample data? This is an important question, one that you'll have to answer and consider. I actually believe it's a very good idea. And so I would encourage everybody to split their data in half and do that as an extra step. Now, for me personally, I don't do it. And I don't do it for two reasons. Number one, I generally focus on old ideas. So most of my developing and testing is already on out-of-sample data. And secondly, I follow an extensive strategy and equity curve stability review process to test robustness. So I basically have two screens of robustness. I find I spend most of my time in the libraries amongst dusty old books looking at old ideas. And I'm such a big believer in risk of ruin and discovering any possibility of risk of ruin that I do have an extensive equity curve stability review process, which you'll see more later on. So I personally don't do it. But having said that, I would encourage everybody to split their data. So let's see if we can develop a trend strategy based on Dow theory. But wait, remember, I recommended that everybody have a strategy benchmark. So we need our strategy benchmark, which in my case is the turtle strategy. I need to put my benchmark up front and center of everything I'm doing. So remember, the turtle strategy is a really simple strategy. It enters on a 4-week breakout, and the stop is just an opposite 2-week breakout. And the filter for the turtles is it'll only take a 4-week breakout if the prior signal is a loss. This is the turtle strategy, and by the way, technically it's not all out of sample because the strategy wasn't taught until 1983, although it had obviously been used before 1980, but publicly it wasn't taught until 1983. So really, it's 42 years out of sample, but the strategy was being used way before it was taught. So that's all out of sample, upward sloping, fantastic. So this is my performance review, remember? Unfortunately, there's no supermetric, there's no one single supermetric that can rank strategies. So I have this performance summary that I use. So let's put the turtle strategy up here because this is my benchmark that I have to beat. You can choose to have another benchmark, but whatever your benchmark is, when you are developing your strategy, you have to have it in your spreadsheet. You got to remind yourself, this is what you have to beat. We know it's got plenty of out of sample data. It's got a positive expectancy, which gives me a 0% risk of ruin, so a big tick. I know I'm not going to die. I want to know what the pain is, and it's a reasonable amount of pain. It's got a fantastic risk reward and a brilliant also performance index, and it makes money. It's quite efficient at making money, and it's got a reasonably smooth equity curve. Not perfect, but it's not rough. So that's the benchmark that we have to beat. So now Dow theory. Let's see if a straight daily Dow trader model would work. Just straight off the bat, looking at Dow theory, I want to know, hey, it's 125 years old. How about we just trade the straight Dow model? It's always in the market, going long, going short, see what happens. This is the S&P 500. It's from August last year until early March when I made these slides over a month ago. We're going long here because it's taking a swing low here. So Dow theory is long. So the daily Dow model is working off daily. This is daily bars. The black swing chart here is based off the daily bar. So this is a daily swing chart. So this is the daily Dow trader. Goes long. When we're long, we're looking for higher lows, whoops, lower low, it goes short. Excuse me, it goes short here. So it gets stopped out and it goes short. Being short, we want to see lower highs, whoops, higher highs. Dow theory goes long. So the short is stopped out and it goes long. So Dow theory is long and it's looking for higher low. So we have a higher low, that's good, higher low, whoops, lower low. Dow theory goes short. Look for lower highs, whoops, higher highs. Dow theory goes long. When long, we're looking for higher lows, whoops, lower low. Dow theory goes short just after the top, of the S&P in December last year. It goes short here. And it's short. What's short? We want to see lower highs, whoops, higher highs. Dow theory gets stopped out and stopped in reverse. Dow theory is long. We're long, we're looking for higher lows, lower lows. Dow theory goes short. We're short. Want to see lower highs, whoops, gets stopped out. We've got a higher high. So Dow theory gets stopped out and goes long. Dow theory is long, looking for higher lows, whoops, lower lows. Dow theory has been stopped out and Dow theory is short. Okay. And Dow theory is actually still short the S&P. So that's the daily Dow model. It's been known since 1900. It's 125 years old. The question is, does it make money? Should this be a methodology that we trade? Let's have a look. This is the equity curve, and it's all out of sample. Is it the perfect equity curve? Of course not. It's got a nasty drawdown there, but that's an equity curve, and it is profitable. Let's have a look. Well, we've got plenty of out of data sample here. We know it's old, but it's all working off the same data. So all this stuff's working off the same data. It has an edge of 6%, so I'm going to be trading with a 0% risk of ruin. It makes money, but it's got an awful, ugly drawdown, which gives you a very poor risk reward and a low performance index. But having said that, because the daily swings are smaller relative, say, to the turtle's 2-week stop, it's been quite efficient at making money, like 1.6 billion. Even with that drawdown, it's made 1.6 billion. So that's a 26% compounded annual growth rate, which is excellent. and it has an R square over 90%. So not bad. But for me, apart from knowing whether I'm going to survive or not, risk of ruin, the first metric I always zoom into is the drawdown. And to me, that's way too big. So it's not good enough. What to do? Let's see if a straight weekly Dow trader model would work. So it's the same idea, it's still Dow theory, but rather than working off a daily swing chart, let's work off a weekly swing chart. So we'll just go up a time frame, go up to the weeklies and see what the weekly gives us regarding Dow theory. So it's the same market. These black bars are still the daily bars for the S&P 500 from August last year to just a month ago. But these green swings are the weekly swings. As you can see, takes out the previous weekly swing high. Dow theory is long, looking for higher lows, high weekly low, a higher weekly low. Whoops, a lower weekly low. The weekly Dow trader goes short. And because we're short looking for lower highs, that's lower highs. Whoops, higher high. So the weekly Dow trader goes long, and then wants to see higher lows. Whoops, lower lows. Weekly Dow trader goes short here, and it's still short as of today, with the market down here. So that's the weekly Dow trader. But the question is, we understand Dow theory's peak and trough trend definition. We understand it's a stop and reverse model. We're always in the market, either long or short, and we can understand the clear signals, but does it make money? Well, I can tell you, believe what you see. That's all out of sample performance. So let's put it up here. We can see that on the weekly time frame, it's got a much higher expectancy, which is wonderful. So I know I'm going to survive. Makes more money, which is fantastic. Oh, look, the drawdown is half. I'm going to say it's half. I mean, obviously it's not half, but it's near half. That's a big improvement. And so its risk-reward ratio is much better, 10 to 1. And oh my God, look at that. The also performance index, that's very high. The weekly Dow trader gives you 2 units of return for every 1 unit of the historical average drawdown. And it makes a heap of money with money management, over 2 billion. And it's a great, the equity curve, is really good, 96% for the R squared. Clap, 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 I like it. But even though the drawdown is much improved, for me personally, it is still too high. So let's see if a monthly time frame works. We saw the daily time frame, we saw the weekly time frame. The weekly was really good. Let's see what a monthly time frame does for the Dow model. This is the same chart, but it goes back much longer. It goes back to July 23. The red swings are the monthly swings, and you can see that the monthly Dow model has gone long here, taking out the previous monthly high, and it's long, and then it went short here, and it's still well, it wasn't short on the 3rd of March a month ago, but it's definitely short now, I can tell you. Okay, question though is, does it make money? And I'm glad you asked, because look, yes it does. Is it perfect? No, but I can tell you, no strategy is perfect. All winning strategies have drawdowns. Excuse me. Let's put it up. So, monthly Dow trader. Now, this is interesting. Although you probably won't have time now because I'm going quite quickly through all of these slides, but when you get the chance to re-watch this whole presentation, just have a look at all of these metrics, how they move around, and look how the Dow theory, as we've gone up a higher time frame, the expectancies improve, which is wonderful. But you can see from the monthly, the profit dips. And unfortunately, the drawdown is too big. And look how the money management changes. The monthly only makes 7 million with money management applied compared to the weekly, which is 2 billion. And yet, see how the monthly has a 98% R square? It's actually got a better R square than the weekly, right? So it looks like it should be a champion, but its efficiency at making money is very, very poor. And it's got a large drawdown. So what we're seeing there is just the raw Dow model over 3 time frames, the daily, weekly, and the monthly. And looking I know I'm going to survive because I can see my risk of reward at 0% here, here. But would I want to trade these strategies? And the quick answer is no. The absolute drawdown is too much for me. So the question is, what idea can I use to lower the drawdowns? Now, what I'm doing is taking you through, how I develop strategies. I want an old idea, have a look at it. And if it's not good enough, which at the moment Dow theory is not, what can I do to make it more appealing to myself? And for me, I don't like huge historical drawdowns. And so I want to look for ideas. So we think, let's not just pull something out of the air and make it up. And, I want to use also old ideas to help an old idea like Dow theory. So how about we introduce an idea from the turtles, which is their loss filter. And what the turtles say is that they'll only take the next signal if the previous signal was a loss. So let's see if that works on the daily Dow model. So we can see here, we've gone long here on the daily example here, and it gets stopped out here. But we didn't go short on here. We didn't take the Dow theory sell signal here because the prior signal here was a profit. So we didn't take that one. So we skipped this signal, which is good because this signal got stopped out up here, which we have to take because the prior signal was a loss. So we take this signal. We come up here and it gets stopped out here, and that's a profit. And because that's a profit, we don't take the Dow sell signal here because that one was a profit. So it's a very simple rule. We only take a Dow signal if the prior Dow signal was a loss. Okay. Question is, does that have an impact on its performance? And yes, it does. It has a huge impact. If you can remember its earlier raw equity curve, just the straight down model, you can remember they had that awful drawdown here of almost $400,000, right? Well, look at that. It's still a drawdown, but it's just almost completely vanished. Fantastic. So let's compare it to our original straight Dow theory by putting a loss factor in. Well, how about that? Fantastic. We make more money, and we've actually, halved the drawdown. And look at the risk reward. It's boomed 13 to 1 compared to 4 to 1. 4 to 1. And the ULSA performance index, it's wonderful. 2.3 units of return for every 1 unit of historical average drawdown. Wonderful. And look at how efficient it is in making money. 3 billion. Fantastic. And look at the shape of the equity curve, the R square, 97. Oh, I can see, three good ticks. But that drawdown, it's still a bit big for me. Let's see what happens with a loss filter for the weekly Dow model. Okay, so here, weekly Dow model is taking this trade here. It's profitable, but we don't take this weekly Dow sell signal here because the prior one was profitable, right? We only take the signals if the prior one was a loss. This one here's a profit, so we don't take that one. Does that improve the result of a straight weekly Dow model? Well, let's have a look. And you can see, I think it's fantastic. Let's compare it. Even though our absolute profits have dropped down, it has reduced our drawdown. So that's a positive. Our risk reward's the same. We've dropped a bit on our risk adjusted returns. And certainly, we've lost a lot on our efficiency. So look at that, it's less than half. So that's not positive. Okay. The shape of the equity curve is about the same, a little bit less. So it didn't have quite the same impact on the weekly time frame as it did for the daily time frame, but all we can do is code, review, and adjust, and rinse and repeat, and look at all these things without going excessively into curve fitting. How about on the monthly Dow model? Okay. Unfortunately, there's no examples here to show you because the time frame's not long enough, but the same idea. We run it. We only take those those monthly signals. If the prior monthly signal was a loss, we have the results here, and it drops the results by a half. It does lower the drawdown, which is good, but the risk return is poor. The ultimate performance index is not very good, and look, it hardly makes any money. So, question is there another idea I can use to lower the drawdowns? Let's introduce an initial daily single bar stop. So what we've been doing in the past, let's see if it works on a daily down model. In the past, for this example here, we've been using the Dow or the swing point as the stop. We go along here, and that's our initial stop down here, and we just keeps trailing before we get a reverse signal. In this case, rather than using the closest previous swing point here as the initial stop, we're going to introduce a single bar stop here. And as the following swing highs get higher than this initial stop, then our trailing stop will go up. Okay, so rather than risking our whole swing as a stop, as our initial stop, we're just going to risk a single bar. And let's see what that does to our results. So we're not going to risk a big swing gap as our initial stop. We're only going to risk a single bar, and then if the trade's profitable, then and if the next swing low is higher, then our trailing swing stop will move up. And that's a performance. Looks good. So let's compare that. Now, it doesn't make a huge difference. It certainly improves the absolute results, but it does increase the drawdown. It's a bit disappointing, but it does make more money. It's far more efficient because our stops are lower. See, we go from 3.4% to the average stop of 2.5%. So we make more money on the efficiency, and our equity curve is actually a little bit smoother. So that's positive. How about on the weekly down model, where we're just going to risk a single bar? Oops, what happened there? We're just going to risk a single bar. Just trying to find my cursor. There it is. This is the weekly down model, where we're just going to risk a single bar rather than a whole weekly swing point here. Let's see if that improved results. So we can see it does reduce the profits here from 1.7 million to 1.3 million, but it does reduce the drawdown from 175 to 108. That's a big improvement. Still got a good risk reward, still contributing on a risk adjusted basis, and it still makes plenty of money. It makes far more than the 800 million. It makes twice that, 1.66 billion. Although the smoothness is a little bit less. Next, because remember, we're just rinse and repeating. We're making these adjustments. Does an initial daily stop help the monthly down model? So once again, this is a monthly signal, the Dow signal, takes out the previous month's high. So the monthly down model goes long. And we're only going to risk a daily bar here. And as the market moves up and our monthly swing lows are higher, then we raise our trailing stop. And this is the results. And unfortunately, you can see every attempt we've made with a monthly model, the results have come down. But the drawdown is a lot lower, so that's positive. Now, what we've done, we've taken an old methodology, and we've basically we've done the coding, looked at the results, not happy with the drawdowns, and we've introduced a few ideas to adjust it and review it and adjust it, and we've done quite a bit. So the question is, which combination represents the best robust strategy? Well, the answer depends on each individual trader's preferences. All are profitable, all are robust. But for me, I prefer to minimize drawdown. So the two strategies with the two combinations with the lower strategies are the weekly and the monthly. And for me, I prefer the modified weekly Dow trader strategy with the loss filter and the initial daily stop. To me, it has a tradable robustness. That drawdown, although it's not pleasant, it's not going to knock me out, it's not going to kill me. So for me personally, I can handle that. And in addition, the small stops makes it efficient. The small stops of only 2.8% means historically it's made 1.6 billion, which is a 26% compounded annual growth rate. So for me, you guys may be different, but for me, I'd go with the modified weekly Dow model. And that's all I do when I develop a strategy. Old idea, code it up, adjust it, rinse, repeat, and avoid excessive curve fitting. And next tip is that we need to do an equity curve stability review, where we've got to make sure that the equity curve going forward can be as stable as possible. So we had a look at this before, and it's all about following good design principles, and it's all a function of how many indicator variables a strategy has. So good design principles embrace simplicity. Okay, few rules, few indicators, few variables, and ideally you have the same variable values across all markets, and you have the same variable values for both buy and sell setups, and you have the same variable values for all market conditions, whether it's trending markets, range-bound markets, expanding or contracting markets. So understand this: too many variables will create too many degrees of freedom. Too many degrees of freedom leads to excessive curve fitting. Excessive curve fitting results in too much flex in equity curves. And too much flex increases the risk of ruin being above 0%. Therefore, it kills equity curves, it kills strategies, it kills traders. So, too many variables kill both strategies and traders. So, understand that all traders at some point in time will tweak their variable values. And why do they do that? Because one, greed. People are always chasing yesterday's best returns. And secondly, it's just human nature. People tweak just because they can. So generally, a change in one variable will alter the equity curve. The question is, how much change? What's the impact going to be on the risk of ruin? And what impact will it have on tradability, the smoothness, the R square? So understand that different variable values will produce different equity curves. Traders need to know the upper and lower boundary of a strategy's universe of possible equity curves. And I'll tell the traders two things. Is there a risk of being ruined? And is it going to be a smooth ride or a bumpy ride? So the objective of doing an equity curve stability review is we need to know a strategy's total number of variables, how many adjustments you're going to allow, and then the resultant number of possible equity curves. And once you've done that, we have to know what the impact is on their risk of ruin and tradability calculations. Let's look at an example. I have a simple indicator strategy here called retracement trend trader. It's got two trend tools, a 34 and a 250-day moving average, and it has an RSI with a 10-day look back with a 20/80 decision level. Now, they have in total 4 variables. Very simple strategy. The market has to be above both the 34 and the 250-day moving average. If the RSI here is below 20, it will take a first breakout up here, and we'll use a trailing stop before we get out. Now, we need to know what is the resultant number of possible equity curves given the number of variables a strategy has and the number of adjustments. Now, I usually allow 4 adjustments per variable. I take 10% of the value of the variable, and I make 2 adjustments above the preferred value, and I take 2 adjustments below the preferred value. Now, to work out the possible number of equity curves, all we do is we take the number of variables, and then we take it up to the power of the number of adjustments. So it's 4 to the power of 4, which is 256. So this simple indicator strategy here with 4 variables has, in a parallel universe, it has working away behind the scenes where the poor trader has no idea, 256 alternative equity curves. And that's just when I'm allowing only 4 simple adjustments. If you want 5 or 6, then by gee, that number is much bigger. So we've got to be aware that indicator-based strategies suffer from variable overload, causing equity curve instability. Look at this strategy using a MACD and a stochastic. It has a total of 7 variables. That gives you 2,400 possible equity curve combinations. Look at this strategy here with 2 trend tools. This is a very conservative strategy. You have 2 trend tools, so you want to be doubly, confident on your trend. So you got one trend tool confirming the other trend tool, and for your retracement, you got one retracement tool confirming the other retracement tool. But in total, you got 10 variables. If you've got 10 variables and allowing 4 adjustments per each variable, you've got over 10,000 combinations. Whoa, who knows what impact that will have on your risk of ruin calculations. So if we look at this retracement trend trader, all I've done here is made 5 adjustments to either the 34, the 250, or the RSI inputs. And look how much variability there is by just making 5 adjustments. This is the original strategy: 34, 250 moving average, 10-day look back, 80-20 for the RSI. It gives you a 17% expectancy over my P24 portfolio. You combine that with 20 units of money, you got 0 risk of ruin. But look at this. I adjusted the 10-day look back period for the RSI down to 6. My expectancy goes down, but my risk of ruin is still 0%. But then I lowered the RSI down to 5. My expectancy dropped almost in half. And look at this, my risk of ruin suddenly goes to 21%. I dropped my risk of ruin, my RSI look back period to 4. My expectancy is down a touch. My risk of ruin bumps up. All right, once again, I reduce it again to, by 1 to 4. I have the expectancy's gone down, and my risk of ruin is up to 24%. Over here, I adjust the first moving average from 34 to 50. I have a risk of ruin of 29%. And then I adjust the 250-day moving average. So each one variable's 50, 204. I get an expectancy of 5%. I have a risk of ruin of 32%. That's terrible. So the whole idea of an equity curve stability review is know how large the parallel universe is of alternative equity curves, which is a function of how many variables you have and how many adjustments you have. And you can see down here, we had too large a variation, and we had, do any sets of the variable values have a risk of ruin above 0%? Yes. If it's yes, we have no business trading this strategy. So how does the turtle strategy benchmark look? We know that the turtle strategy only has 2 variables, a 4-week channel breakout for entry and a two-week channel stop. So turtles have 2 variables. Okay, rules are very simple. And we need to know how many possible equity curves there are. And look, there's only 16. So we've got 2 variables here to the power of the adjustments, which is 4. So the total possible equity curves is only 16. So we only have to calculate 16 equity curves to have a look at all the risk of ruin calculations. You can see these are all the 16 equity curves here. And have a look at this. Now, I changed it from 4 weeks in and 2 weeks out to 20 days in and 10 days out, because it's a lot easier to take a 10% adjustment of 20 days and a 10% adjustment of 10 days. So you can see here, this is 2 adjustments down because it's 20 minus 2 minus 2, which is 16. This is 1 adjustment. This is 20 minus 2. 10% of 20 is 2. And then the breakout here we've looked at, we've added 2. And we've added another 2, which is 24 for the breakout. So these are all the combinations. But what is the most important thing is, with all these combinations, look at the risk of ruin, 0%. Can we trade the turtle strategy? Yes, we can, because it's got no risk of ruin calculations above 0%. So how does my modified weekly Dow trader look with the $108,000 drawdown? Well, let's count up the variables. How many variables are there in the weekly Dow theory? 0. Weekly Dow theory is just price. It's a stop and reverse strategy. The initial stop, daily stop, it's just price. It's just 1 bar. And the trading stop is just a weekly swing low. There's no variables. So 0 to the power 4 gives you 0. There's only 1 equity curve, which is the original equity curve. So you can see here, no risk of ruin. So when we line it all up, we have an expectancy of 29%. we definitely have out of sample performance, which is fantastic. And how many variables, how many indicators are in the modified weekly Dow theory? There's only 0, none. How many adjustments? Well, you can't make any adjustments if there's nothing. Number of possible equity curves, there's only one. Is there any variation? There's no variation. There's no variation in the expectancy. Are there any sets of variable values that produce a risk of reward above 0%? No. So, is the equity curve stable enough to trade? Yes, it is. Okay, this is what an equity curve stability review does. It's really important. Everyone has to do it, particularly if you've got an indicator in your strategy. And finally, we have to compare our development efforts with the benchmark. And here we are. Certainly, Dow theory is older. It has a better expectancy of 29%. Risk of ruin is 0%, so that's good. The modified Dow theory makes less than the turtle strategy. Without a doubt, makes less, but it's got a lower drawdown. So that even though turtles makes more on a single contract basis, maybe it's less likely you'll get to enjoy that because maybe that drawdown is so big it'll knock you out. This is certainly a lower drawdown. It has a good risk reward. It's also performance index is not as good as the turtles, but look at this for the efficiency. The weekly Dow strategy with a single daily stop, its average stop is only 2.8% compared to the turtles 4.5%. It's much smaller, so it makes it far more efficient. You're making 1.6 billion as opposed to only $500 million. It's far more efficient with a 26% compounded annual growth rate. Very good. It's got a shorter drawdown period in terms of days, but it does have 3 extra losses in terms of the longest losing streak of trades, which is 22, and the curve is slightly less smooth than the turtles. But the important thing is, the key metric for me, if I know I'm going to survive, is what is the potential pain, and it's got less pain for me, and in addition, it's far more efficient at making money because it has far lower stops. So for me, hands down, the modified weekly Dow theory beats the turtle trading strategy, hands down. Finally, I tell you, if you want to be serious about making money, you've got to put a lot of effort in. So if you get to that stage and your efforts beat your benchmark, then congratulations. Give yourself a pat on the back, but don't put real money into the market just yet. The last thing you have to do is you have to perform a test, right? You have to perform a test. You have to do 30 email simulated trades. So you need to go and find somebody from the ATAA and find a trading partner. Okay, and they're going to agree to become your virtual broker, and hey, you can agree to become their virtual broker for when they wish to develop a strategy to trade, right? So get your trading partner, and then you'll email them before the market's open. Like I've really put my orders into IB. IB knows exactly what I want to do, and it's like 1:30 Sydney time. So we'll be finishing shortly. You need to email your orders before the market's open with the complete orders for all of your simulated open positions and new orders. Your partner will become your virtual broker. Now, they'll print off your email each morning and they will record the results of your instructions on that piece of paper or in a spreadsheet. Now, they won't accept any instructions that you email after the market opens, so there's no cheating, no, right? If you're going to be serious about the markets, you've got to be serious in how you develop and proof a strategy. They will then send you a spreadsheet summarizing the results of your 30 simulated trades. If positive, good, off you go. If negative, just repeat the whole process. And that, everyone, is my development toolkit. Now, this is extensively detailed in my book, along with the modified weekly Dow theory, my book, The Universal Tactics of Successful Trend Trading. So if you like this presentation, then everything I discussed today is in my book. If you are serious about making money from the markets, then I can't encourage you enough to get a copy of both these books. In my opinion, they are mandatory for the serious trader. So that brings me to the end, guys. We talked about my beginnings, where I was a discretionary trader, and for the tools that I learned, for me personally, I wasn't successful with those tools. And during that period, I blew up 2 accounts, and I almost blew up a 3rd account until I discovered mechanical patterns, and that's what I am. What I've been for the last 20 years. I just trade mechanical patterns, and I've enjoyed the benefit of being a mechanical trader. And as I said before, diversification works, and I really see myself more as a risk manager as opposed to a trader. And I've just shared with you how I go about developing strategies. And the key to what I do is I look for old ideas, because they give me the golden benefit of out of sample data and out of sample performance. So everyone, thank you for your patience, and I wish everyone good trading. And I believe we'll have a Q&A session here. So I will stop I'll stop sharing my screen. And
Just
I'll
you can keep sharing for now,
Oh,
Brent.
okay.
Just in case you need to refer back to the slides for the Q&A.
Oh, okay.
But thank you very much, firstly, for a wonderful in-depth talk. I think having a very good approach to strategy development is one of the keys to becoming a successful trader. And I think that deep dive that you've just given us gives us a very clear overview of the steps that need to be taken. And as you say, it's something that is not easy, but if you are serious about making money, then that is the what you have to go through. We do have a few questions, so if you could just hang on and address some of these. First one from Benny asks, he wants you to explain a bit more about the turtle trading 4-week and 2-week breakout stops. He knows there's a simple moving average version, but is this something different from that?
Sure. I'm not aware of the simple moving average version, but the turtle strategy is very simple. Essentially, you got your daily bar chart, and just overlay on your daily bar chart a 4-week channel and a 2-week channel. The 4-week channel high will just be recording the highest high of the last 4 weeks, and the low will just record the lowest low of the last 4 weeks. And that was a red channel that you saw on my chart. They give you the entry orders, the buy or the sell. And so it's just a 4-week breakout. So the markets move up. If prices take out that 4-weekly high, turtles will go long. And then once they're long, they work a stop. And the stop is just the opposite breakout of a 2-week low. So the blue channels you saw on my charts, they represent a 2-week channel. And so the 2-week channel, the upper part of the channel is just the highest high of the last 2 weeks. And the lower blue channel is just the lowest low of the last 2 weeks. So if the turtles goes long, because it broke out of the red 4-week channel, you'd place a stop, opposite stop, for a breakout at the low of the 2-week low. And the sweet trick that the turtles, and by the way, the turtles built their strategy off the back of Richard Donchian's 4-week breakout, which is even older. That was shared to the public in 1965. So the turtles were smart too. So think about this. The turtles were smart to develop their strategy also off what? An old idea. So, and what the turtles guys did that was smart was they introduced the loss filter. So they'd only take a 4-week breakout if the previous signal was a losing strategy. And that's how I understand the turtle trading strategy is. I haven't come across a moving average one, but that's my understanding.
Okay, fantastic. Thank you. Next, we have a question that asks, how much is the max drawdown of your strategies? And I think what they're driving at is when you trade them as a portfolio, do you have a metric for what your maximum drawdown has been whilst you've been trading the complete set?
Oh, my models. Yeah.
Yes, in percentage terms.
Oh, well, it's basically um, I work off single contract positions, and I trade Universal Trader, which I make available to people, and I show people how I trade that. But in addition to that, I've got other stuff as well, and you know, probably maybe the question is the max pain I want to really incur is maybe 200,000. All bundled up. I can handle that. I don't like it, but I can handle that. Um, but I trade multiple strategies, all the time, and my two recent drawdowns, basically in 2021 and 2023, were basically just over 30% and just over 35%, and they weren't comfortable. In terms of an absolute dollar amount, I draw the line at basically 200, over $200,000.
Great. Okay. Next question is, do you think the markets have changed permanently now? So many people are momentum traders using ETFs and index funds.
Oh, that is
And
mhm.
do the fact that the legacy strategies that you do trade not they weren't invented in that type of world, does that affect their outcomes today?
Oh, that is a fantastic question, because it's such a logical question, right? Um, and yes, everything changes. Um, we have just during our lifetime, we've seen pages come and go. We've seen day trading pits close. We've seen electronic trading come. We've seen almost 24-hour trading come. We've seen new instruments. We've got CFDs. We've got so many platforms. We've got smartphones. We've got AI. It's a completely different landscape today than when we started, 40 years ago. So the big answer is yes, it has changed. But then I say, no, 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 no. The markets have not changed. Okay. If one of my strategies, and I do monitor my strategies, individual equity momentums, and if a model, I usually do it at the beginning of each year, and if a particular model's equity curve is looking a bit sorry, I'll switch it off for 12 months, right? And see whether it will recover or not. Now, if any of my models have a permanently, poor performance, and basically stops working, I will never blame the market. I will never blame the market. If my model stopped working, it's because it just wasn't good enough, okay? Because I don't believe the markets have essentially changed. Yes, the characters, the instruments, you got Forex, you got cryptocurrency, you got AI, a cast of characters. They're always changing, right? But the markets are fundamentally made up of you and I, humans, and we have not changed. And we suffer from hubris, and we suffer from fear, and we're a mob. And you just have to look at what's happened over the last week. Nothing's changed. Now, if you want evidence about so any strategy that you and I develop, right, has to have performed well and survived what we've survived in the last 40 years. If you look what's happened since I've been around. I mean, I traded the 87 share market crash. You had the savings and loan debacle in the US. You had the Asian currency crisis. You had that long-term asset management. You had these academic, professors with long-term capital management saying, "Oh, markets follow a normal distribution." You know, there's only like a chance of 0.01 that the market will move, 4 standard deviations from its average movement, over the next 50 years. The markets are random. Of course, they're not. If you look at the fat tails and the thin peaks, you'll know markets are not random. And the thing blows up, right? Then you had the bloody housing crisis and the quantitative easing. So we're sort of lucky that there's been so many financial mishaps over the last 30 years. You couldn't ask for a better backdrop to basically bench test what you're doing because it's been so volatile. And so it's yes, the landscape appears to be constantly changing, but the people who sort of magnify those changes, you and I, we're the same. And so I don't think the markets have changed. It's just the labels. And if you don't believe me, look at Dow theory. I've just shown Dow theory, which has been known for over 192 years. And sure, I'm not saying that you want to trade the straight daily Dow model or the straight weekly Dow model or the straight monthly Dow model because the drawdowns they are big, right? But the fact is, they're all enjoying new equity highs with the background I've just described. So in one sense, you can be convinced the markets have changed because you see so much changing. There's crypto, there's all these trading platforms, there's AI, it's so different from say when Charles Dow was doing his analysis, right? But guess what? I don't think anyone shows what I've just shown you guys. You don't get to see stuff like that, okay, first of all. And I've given you an insight. I've shown you what a 125-year-old idea has been able to do over the last 45 years of data that I have from a Norgate. That sure, is it a smooth ride? No. But I can tell you there's no such thing as a smooth ride in trading. But do they make new equity highs? Absolutely. You've just seen them. New equity highs. So the question is, have markets changed? Well, yes, on one level, but deep down, no, they haven't. And there's evidence of that. Look at these old models I've just showed you and how they're still enjoying new equity highs, despite all those financial turmoils during the 80s and 90s, early 2000s. And Trump, right, just recently. Dow, how can I call up another PowerPoint?
Yeah, please
Alan,
go ahead.
How do I do that?
Well, we're seeing your screen. So if you put anything on that screen, we'll be able to see it.
Oh, okay. Let's go over here. Over here. Oops, hang on.
You'll have to reshare. I think we just lost it there.
You stop sharing as the window closed. Okay, so
Yeah.
I'll just have to redo that. Let me just open this one. And then we'll go over to here. Zoom. No. Alan. Open you up. Share. I'll pick. There we go. Share. Hit share. Sharing. Can you see that?
Yep, that's coming through.
Okay. Well, this is I've got myself a little bit. I can see myself. I'll move that down. There we go. Here we go. So it's a brilliant question, right? Because it gets to the root of people's confidence. Things have changed. So and unfortunately, the marketers, to basically dig into your neurotransmitters, will take advantage of that and say, hey, well, the markets have changed, haven't they? Hey, you don't want to be left behind, do you? You have to get with the new stuff. Hey, if you don't get with the new stuff, you're going to be left behind because the old stuff is no good because the markets have moved on. Don't you agree? Come and get the new stuff. And that hits your neurotransmitters and you go, hey, I don't want to miss out. I want to go for the new stuff. So you follow that shiny object. But they're just marketers and they don't trade and all the rest. But they suck us in. And so if you want evidence that the market's essentially, which is just you and I all made up together, because we're humans, we haven't changed, and we make up the mob, right? We really haven't changed. Look at what Charles Dow's got you doing. This is his daily Dow model on the S&P 500. This is from 2 days ago. It has you short. You had a great trade up here. I'm not sure that was probably, I don't know when was that. Early March, late February. Lovely trade here. And you're short now. That's on the daily Dow model. Look at the weekly Dow model. Charles Dow, who's been buried for 125 years, this is a fantastic magic trick. He's able to get a short here in late February. And for the monthly one, long term, you've been short for over a month. So that's a long-winded way to say the markets haven't changed, but it's a fantastic question because it puts doubt in everyone's mind, and probably it's another reason why you do need to look at old ideas because they give you the gift of out-of-sample data that allows you to keep going, even with this background of terrible volatility. Hope that all makes sense.
Yeah, that was an excellent answer. Thanks for that, Brent. Okay, we just got a couple more. Kevin asks, do your books go into details of the formulas and the information used to construct the strategies?
The ones I shared.
Yeah, in your books are the actual
Yeah,
formulas
yeah,
for
yeah, yeah,
the
yeah, yeah,
indicators
yeah,
and so on in
yeah,
there?
yeah.
Yeah.
Well, I don't use indicators. So the models that we've just developed is based
Yeah.
off the backbone is Dow theory. So in my trend trading book, yes, I do talk about Dow theory because I build up the modified weekly Dow trader into what I've just shared with you. That's in the book. So all those steps are in the book.
Great. Fantastic. And final one here. Someone asks, they note now that the CMA has introduced micro futures that mirror the large versions in various markets with low margin requirements. Do you think a relatively small account sizes can now feasibly trade those future
Oh,
strategies?
absolutely. I have traders with me right now doing our 90 days of live trading together, and they have large accounts, but a lot of them haven't done mechanical trading. And so I've encouraged them not to trade the standard contracts, but to trade the micro contracts. So they just get used to trading a mechanical system, right? Because it takes discipline and routine. So I think they're a great feature. And for those with less risk capital, it's perfect. They're fantastic. They've got zero counterparty risk. A big problem when you trade with CFDs and Forex is you're basically trading against the house, the supplier. And you don't know whether those providers have good credit rating or not, whether they'll be around to pay out your profits. And with micro futures, every futures contract has an exchange sitting between you and the other side. And through novation, all of the profits are guaranteed to be paid out, just like they guarantee to take the losses out of your account. And I think it's a brilliant thing. I wish, like, if I was talking to myself, I mean, I started off essentially trading the SPY back in '83 because when we were at Bank of America, you could not trade in the markets that you were responsible uh, um, for the bank. So I was manager of the short-term bank bills. So being a bank, it's interest rates, and then you had foreign exchange in the money market desk. So no one traded in, bank bills or 10-year bonds or currencies, right? But we we all punted on the SPY because that was equities. That was, the share market. Um, and that was when the SPY 200 was 4 times the size of it is to today. And that's how I got started. And why my website's called Index Trader because it's just what I was introduced to, right? If I had my time again, um, I wouldn't want to just be reliant on one market like the SPY. I would want to trade a diverse portfolio of markets. And with these micro futures contracts, you can probably, afford to trade, a little four market portfolio, which is diversified through, whether it's commodities or interest rates or currencies, with probably like a $10,000 account.
Mm.
Off you go, and you just chip away. You just got to trade
Yeah.
really small relative to your risk capital, and bang, you got all this scalability ahead of you.
Yeah. Fantastic. Well, Brent, I really want to give you our sincere thanks for taking the time out of your weekend and out of your week for the preparation to give us the benefit of your knowledge. It's been a really fantastic presentation, and I do hope that everyone's enjoyed it. I'm sure they still have because the numbers that we have in the room have maintained at the high levels that they started with. So that's a good sign. So once again, Brent, just a very good thank you from myself and on behalf of everybody at the ATAA here.
No worries, and thank you for your generous invitation, and thank you to everybody for taking time to spend a few hours listening to me.
Thank you very much, Brent. And just a reminder, everyone, that the offer to join the ATAA for $1 for the first 3 months still remains open, and you can check out the link for that in the chat there. But with that, I will thank you everyone for their time today. Wish you good luck, good trading over the time. There's lots of thank yous coming in through the chat, Brent, and we hope you'll join us again for the next in this series, which will probably be in July. So keep your eye on your email and the socials for that. Otherwise, enjoy the rest of your weekend. Thanks, everybody, and bye for now.